everybody, Brent Kluge with 203kworld.com video blogs, and today's topic I'm coming to you with how to make your 203k a two-step process. So what does that mean? 203ks, as we've discussed before, have this one thing that's kind of a nuisance, and it's called mortgage insurance. That's money that you pay to HUD. Nobody gets really any benefit, no clients get any benefit from that. That's for HUD. It secures insurance so that if you default on the loan, they will foreclose and take possession. So it's insurance. You really don't get any benefit for it. And it's pretty costly too. So two-step process on a 203k. Here's what happens. 9 times out of 10 in today's market, people are buying properties for 50, 60, 70 cents on the dollar. And when you buy them right, normally when you do your renovation, you'll have 20% equity position or better when you're done. Once you have that 20% equity, you qualify conventionally for a loan with no mortgage insurance. So a lot of people will ask me, Brent, what about FHA? When I'm done, why can't I just stay in my fixed rate FHA mortgage and prove that I have 20% equity? Used to be able to do that, but not anymore. Now HUD requires that mortgage insurance to stay in place for 5 years. 5 years, you'll have to deal with it. So it's important to set expectations up front, educate yourself, know a pretty good idea how much your purchase price is, how much your renovations are going to be, know how much the place is going to be worth when you're done, so you know if you have that 20% equity position. If you're sure that you don't, then it makes sense to pay a little extra, maybe buy your rate down, because you're going to have to ride out sticking with your 203k loan. There are a few other options like streamline refis that are potentially eligible for you, but it all is dependent on what the market does after you close your 203k. Best case scenario is two-step process. Go to a conventional refinance when you're done. So if you think that you can buy your house and renovate it and when you're done have 20% equity, it behooves you to set your strategy up front to move to a conventional refinance. And there's a few things that you need to know in order to do this. So why do this? Lose mortgage insurance and potentially lower your interest rate. We just discussed mortgage insurance. FHA 203ks are riskier and more costly of a loan than a conventional loan, and a little bit more so than the FHA loan. By and large, they're 0.25% to 0.3% higher than the going 203B or standard FHA loan. So not only will you lose your mortgage insurance, the other thing that you'll do is potentially lower your interest rate, which is great. So, can you lose your mortgage insurance, drop your interest rate? Maybe. It's a good idea to understand up front if you can when you're done your project. So 20% equity, what does that mean? That means that if your house, when it's done, is worth, say, $400,000, your loan amount, 20% of $400,000 is $80,000. Your loan amount, loan to value, LTV, cannot exceed $320,000. So if you know, hey, I'm buying the house for, $200,000 and I'm going to put $120,000 into it, my new loan amount is $320,000, and you do have an appraisal that shows it's worth $400,000, you have your 20% equity position. So it makes sense to strategize to move into your conventional refi. So you'll lose mortgage insurance, you'll lower your interest rate. You'll find your payment on a loan that size may drop $400 a month. It's pretty significant, maybe even more. So timeline, when can this happen? Here's a catch. When you do your 203k loan, your lender is not going to want you to refinance because, number one, he'll have to pay back money, or number two, he may end up getting hit with a charge from whoever he sold the loan to. So the truth in this lending world is that when we close a 203k loan, let's say, for instance, your renovation takes 3 months. So you settle, as an example, at the end of January. So you have February, March, and somewhere around the end of April or middle of April, you're done your renovation. What has to happen in order to make you eligible for your refinance is you have to completely close out that 203K renovation piece. That means that you've received your last draw and the entire escrow account is closed. Once you've done that, you are eligible to refinance. Now, here's the catch. Lenders are paid when they sell the loan to a secondary market. That's how they make their money mostly. Not off of you or charging you fees or out of your pocket, but actually off your volume and selling it. So that money that's paid from the lender that they've sold your loan to, that lender will have to pay that money back depending on how quickly you may do a refinance. So if, let's say, you had a quick renovation and you finished it within 2 weeks, and within 30 days your construction project, your 203K piece, is closed out, and you want to refinance, and you go to another company and you refi conventionally, because why? It drops MI and lowers the interest rate. That lender, the loan officer that you went to do this 203K loan, is going to be back charged because they didn't have enough servicing to who they sent the loan to. So for instance, if I sell your 203K loan to this bank, that bank is going to want to typically collect at least 120 days or 4 months of payments from the date of sale of the mortgage. So what does that mean to you? That means that if you're done your project right before the 120 days, I'm going to hope that you'll still do business with me, that I've done a good enough job, that I've earned your business, that you'll at least wait out that 120 days and do your refinance with me. But I can hope all I want. What do? I will do your refinance for zero lender fee, so that if you are done ahead of time, you stick with me throughout the process. So no matter when your construction is done, if it's done in 2 months or 1 month or 6 months, I'm in hopes that you will come back to me to do the refinance. In fact, I require my staff to stay in touch with our clients throughout the entire construction process. And what do I do rather than just hope that I've done a good job and you'll come back to me for your refinance business? I give you an incentive. Because you did your first loan with me, I will ensure that zero bank fees are charged for your refinance. So, timeline, it's really important to communicate with your loan officer when you would be eligible to do your refinance for your two-step process and drop the MI and drop the interest rate potentially. So communicate up front, understand how long do you have to do this refi without any paybacks or any issues with the loan officer having to pay money back. We've talked about what to do with your refinance, how to make it a two-step process, and we've talked about timelines. Let's talk a little bit about, when we talk about this two-step process, about knowing if you're eligible. So when you buy a house and you renovate it with the 203K, you're going to determine how much work needs to be done through either a consultant or a contractor coming in and determining the scope of repairs. The entire work write-up is done. So we know what work needs to be done. We know how much we're purchasing the house for, and we're going to submit for an appraisal with those forms. So the appraiser is going to say, this house is worth X amount of money subject to these repairs being done. So we would think, hey, look, we know up front how much we're going to pay, how much we're going to invest into the renovation, and how much our loan amount's going to be, as well as what an appraiser says it's worth when it's done. Is this a true barometer as to the true value and whether or not you can do a conventional refinance or not? Here's what I've seen. I don't think it is. Here's why. In the environment that we're in today, FHA appraisers are scrutinized with how exact of a job that they do. In fact, their appraisals are quality controlled. They'll pull appraisals and review. and they'll check review appraisals. And if they get bad reports, they'll pull their appraiser license. So just by the way the lending environment is today, FHA appraiser knows that every appraisal that he does is going to be scrutinized. Now, they have to give it a fair value. Of course they do. But who's kidding who? They know how much you're buying it for. They know how much you're putting into renovations, and they know what number it costs to essentially make sure that the loan's going to work. So if, let's say, for instance, somebody gets a steal on a foreclosure, which this happened just a month ago with my client. They bought the house for a little over $200,000. They put $200,000 in renovations into it, and we had an FHA appraisal that said that it's worth $4.25 when they're done. Does it make sense? Sure. I mean, the value is there, the purchase price and the renovation is there, and the FHA appraiser said, because you're doing all this work to the house, it's going to be worth $425. So they made $25,000 in general math. Okay, great. We knew, the buyer knew and did his homework, that it truly was worth more. In fact, when we were done the construction, we submitted for a conventional appraisal, doing a new loan, a conventional refinance, and the property came in at $575. Now, this doesn't happen all the time, but sometimes what I'm getting at is the FHA appraisal is conservative because they have to be. And you might find more value when you do your conventional refinance. Just food for thought there. One other technique in doing your two-step process is if you know down the road, whether it's 4 months, 6 months, 8 months, or a year, you're going to be doing a refinance, especially within 6 months, you should set the title company up for your purchase to know that eventually down the road, you're going to be coming back to him to do the refinance. And when you do, you can get reduced fees. So negotiate with your title company, probably 2 loans. And so you know up front, you get a preliminary HUD-1 for your purchase, and you say, hey, if I come back to you in 6 months and do this refinance, how much would that be? And shop that too. Makes sense, right? The last thing is extended locks. Talk to your lender, because if you know, hey, I'm going to be done this project and we hope to refinance 120 days after the sale, well, you might be able to get a 60 or even a 90-day interest rate lock. So in case the market goes up, you're protected. That makes a lot of sense too. So 203Ks can be a 2-step process. You can use the 203K to buy that as-is place that's in less than perfect condition, fix it up, make it yours, and then after 4 to 6 months, do refinance to a conventional loan and drop the MI and lower the interest rate. Great process. Think about those things up front. Set it up. Set your expectations. Let everybody know. Once again, Brent Kluge, 203kworld.com. Thanks for listening. As always with YouTube, please help me out in keeping the information going. Click like if you like what I had to say, and maybe even subscribe to 203K World on YouTube and at 203kworld.com. Go out, buy houses, make equity, have fun, enjoy your life. Bye.
Came blowing in from across the sea. It lingered there to touch your hair and walk with me.